Yeah, I think clients have done a good job because we've trained them well over the last couple of years to recognize, as you just said, that geopolitics rarely have long-lasting impact. So the first thing that we're seeing is the clients are staying disciplined, they're sticking with their plan, and that's been the right move. I think the bigger question and the thing that matters longer term in the conversations that we're having is recognizing that we're in a world where it's not just this energy shock, but it's this shift towards global fragmentation, which means that inflation is probably a bigger part of the story going forward. The floor on inflation is probably higher. The volatility of inflation is probably greater. So thinking about the diversification part of your portfolio is not just about bonds, but also thinking about things like infrastructure, real assets, commodities as part of that inflation story.
And also, Steve, supply chains, I think, right, are going to be reshaped because of not only COVID, which is, I think, what sort of raised the flag, but now this war. And how does that have you thinking about opportunity?
Yeah, I think you're right. We went through a multi-decade period of globalization where it was all about the efficiency and low-cost nature of your supply chain. That was great for margins and earnings and inflation. But I think between the pandemic, what's gone on in Ukraine, and what's happening now, there's a recognition of this shift towards, as I said, more fragmentation. Countries and companies are going to focus more on the reliability and security of supply chains more so than the cost of supply chains. One of the interesting opportunities that we've been talking about with clients is this idea of investing in national champions in strategic industries, because I think whether it's infrastructure and power in the US, security and defense in Europe, the technology sector in Asia, you're going to see much more of a focus on developing domestic champions as part of the supply chain story.
Steve, before the war, probably the driving force for these markets and sentiment was AI, artificial intelligence, and I guess the market had evolved from simply, I'm just throwing money in anything that's remotely close to an AI, to now I'm trying to discern maybe winners and losers. How are you guys, what's the conversation you're having these days?
Yeah, I think that's right. And I think that shift really happened towards the end of last year when you saw a shift from these hyperscalers funding a lot of this capital spending from free cash flow to starting to engage credit markets. And I think that caused investors to take a step back and say, we need to decipher not just every spend is good spend, but rather what's going to be effective spend. And I think that that's what we're seeing now. And I think you're going to continue to see that. The good news is we're continuing to see earnings revisions move higher. Valuations, as we've seen a bit of a pause in these stocks, have now gotten more attractive. So perhaps heading into this earnings season, the bar is a little bit lower, even with the rally we've seen in the last week.
But the backdrop to all this, right, is possibly higher oil for longer. Mm-hmm. What is your outlook for oil? I mean, in terms of just how we experience it day to day when we go fill up. I mean, now we've got Treasury Secretary Bessent saying gas should hang around $3 a gallon for the summer, but yet you got the Energy Secretary saying we might not dip below $3 a gallon until next year.
Yeah, our base case is that we do see oil prices continue to gradually move lower, call it $80 a barrel over the next 3 to 6 months. I think that's a good environment for growth. Inflation picks up a little bit, but that's something we can manage. We also do a scenario analysis where we ask ourselves, what happens if we stay around this $100 level? What happens if we see a spike higher? And at the $100 level, it's a little bit trickier for markets because stocks potentially feel some pressure from a growth slowdown. Bonds feel some pressure from higher inflation. That's where you need to look at some of those diversifiers we talked about. Where this becomes more of an economic story is at that $120, $140 a barrel for a while. Then you're looking at a scenario where modest growth year-end outlook turns into potentially a modest recession. And that's what we're focused on. But we think that's a low probability outcome.
What are you telling your clients to do in the bond market here? I've got a 2-year Treasury, get paid $375 for sitting in a 2-year Treasury. That's not a bad living. But take credit risk above and beyond that?
So one, we don't see major issues in the credit markets. We still think that there's opportunities focusing on higher quality credit. But opportunistically, where we've been focused, as you said, is on some of the shorter term bonds, whether that's treasuries or investment grade. Long-term rates have been rather stable despite the pickup in oil prices. Where we've seen a huge move is on the short end of the curve. The markets went from pricing 2 or 3 Fed cuts to a Fed on hold. Outside of the U.S., markets are now pricing central bank hikes between now and the end of the year. And so for our clients who are sitting on a lot of cash, using this as an opportunity to extend duration a little bit, pick up and take advantage of some of that move that we've seen is an interesting opportunity.
We were talking to Damian Sassower earlier about emerging markets, and we're seeing a lot of interest also in Africa as we talk about investments in renewable energy. Mm-hmm. What are your thoughts on EM in this environment?
So we think EM is one of the most compelling opportunities out there.
Really?
Yeah.
Wow.
We think that the story in EM is really one focused on earnings growth and revisions, which have moved sharply higher, particularly when you think about Asia, particularly when you think about markets like Korea and Taiwan that are really essential to this AI capital spending story. And at the same time, even with the outperformance that you've seen in emerging markets over the last 12 to 18 months, valuations are still at a pretty substantial discount. And while we don't have a specific view around Africa, I do think that this deglobalization story and this reorientation of supply chains, diversifying resources, natural resources and things, is going to benefit places like Latin America, which is an interesting investable opportunity.
Alternative investments. I used to think a reasonable allocation to alternative investments would be like 5%, but that's like, no way. People are allocating a lot more to alternative investments. How about the sleepy people at JPMorgan Private Bank? I mean, you're there to preserve my capital here.
I think the first thing is really getting an understanding of investment horizon and objectives, right? And the nice thing for a lot of our clients who are wealthy and they're thinking not just about short-term capital needs and liquidity, they're really thinking about long-term multi-generational wealth. And that's where alternatives do play a much bigger role. When you can give up some of that liquidity in exchange for either potentially enhanced returns or diversification within your portfolio. We did a family office survey recently where we talked to the family offices of our largest clients. And on average, they've got about 40% of their portfolio in alternatives.
Wow.
But again, that's because they're thinking out over decades and centuries. For our other clients, we do think that introducing alternative allocations is important, as I said, both to enhance returns in places like private equity and real estate, but also to give you some diversification in things like infrastructure.
Real quick, is an alt investment in your mind crypto?
So crypto is sort of not a new category, but it's an increasingly focused on category in our client conversations. We haven't taken kind of a strategic view on incorporating crypto into our portfolios. It introduces a lot of volatility, and when you're thinking about diversifiers, that's not necessarily where we want to focus our incremental dollar, but it's an area that we're doing a lot of work on and we're continuing to focus on.